Morning. Well, an enormous day on the earnings front with some big name financials reporting and a shift in power in the sector. We say a shift in power because as Citi reports a loss, a penny larger than expectations, we also learned that with earnings reports, JPMorgan now surpasses Citi as the largest U.S. bank in terms of assets. Also reporting this morning, Bank of New York, which saw 79 cents a share on an adjusted basis. That was better than expectations. And Merrill Lynch reporting a wider than expected loss of $5.56 per share. So will these earnings move the markets today? My guess is yes, but let's talk to the experts. Joining us now to discuss this is Roger Ehrenberg, managing partner at IA Capital Partners, and Doug Flynn, co-founder and partner of Flynn, Zito Capital. Good morning, gentlemen. Thank you so much for joining us.
Good morning.
Roger, since we last spoke about an hour ago, I've had a little more time to review some of these earnings announcements, as I imagine you have. Tell me your first reaction when you got into sort of the meat of the Citigroup number here. What stands out?
Sure. I mean, the losses on credit cards and additional write-downs on mortgage-backed securities certainly was to be expected. And again, I think it's kind of ironic that they came in right about consensus estimates. I think that the bigger issue, Alexis, is it's what's coming down the pike. And again, given the fact that they still have enormous amounts of off-balance sheet assets and potentially additional write-downs to take on their on-balance sheet mortgage-backed securities portfolio, I'm just not convinced that they're going to perform in the ensuing quarters.
Yeah, as I understand it, Roger, they did continue to take back some of the, I guess, the legacy assets that they were not happy about. I know they initially had talked about $450 billion. They've cut them by $50 billion. But you rightly point out that they did increase their loan loss reserves, largely due to the consumer. Doug, let me talk to you, because the consumer now, I imagine, is going to take over the spotlight of what has been happening on these structured investment vehicles. You speak to the consumer every day. What is the consumer telling you about their confidence in the banking system?
Well, if your credit rating is over 700, you're probably somewhat unaffected by all the things that are going on. But there are those people that are in that 600 to 660 range, sort of moderate credit, who are having problems getting credit to do the things they need to do. So they're absolutely feeling that the money is not there. Hopefully that money will get flowing again and allow these people to also do the things they need to do.
Doug, one of the great controversies here, and I will no doubt talk to the Treasury Secretary about this, is that a lot of the American taxpayers felt that this was a capital injection for the institutional banks or the commercial banks, as opposed to addressing the borrower or the homeowner. Tell me, from your point of view, do you think that is the problem here, that at the end of the day, there's nothing in the legislation that speaks to the individual?
Yes, I think that it was very poorly sold as a bailout plan, as opposed to doing what it needs to do, which is keeping the capital markets moving in terms of credit. If the credit markets freeze, everything is going to seize up in terms of business and everything that's related to it. That was not sold properly at all in terms of getting it to the consumer. They really believe it is a bailout of Wall Street.
All right, well, guys, I hate to do it, but I got to leave it here. Roger and Doug, I want to thank you both so much for joining us once again. I appreciate it. Breaking down the details now, let's go to the experts for more analysis. Joining us is Dan North. He is the chief economist for Euler Hermes, ACI. Doug Flynn, co-founder and partner of Flynn, Zito Capital. And Mark Lieberman, our Fox Business senior economist, and Charles Payne. All right, Mr. Lieberman, I didn't have you with me yesterday for the producer price index, but I do have you today for CPI. Looks like better than expected numbers. Is this kind of what we thought we'd see as some of those inflation concerns abate somewhat?
Absolutely. With the slowing economy, there's reduced demand, and as demand comes down, prices come down. This is not a major surprise. Even and at 0.1%, the expectation for the month on the headline index, that wouldn't have been a bad number at all. One of the other aspects of this, and I want to jump in with this quickly, is that this CPI report governs the cost of living increase for Social Security recipients, which is, we're going to look at deeper numbers in a bit, but that's expected to be around 5.5% year over year, which would be about $60 a month for Social Security recipients. So it's at least somebody wins out of this.
All right, well, that's good news. I'm thrilled to hear that. Let me go back to Doug, because Doug, you're the one who talks to the consumer. You're a financial planner. When you see these numbers, particularly these weekly jobless claims numbers, I assume this spooks more fear in the individual investor. What are they doing, and what are you telling them to do in the wake of these disappointing economic numbers, although the market's rallying nicely?
Yeah, all of the economic data you have to sort of take in and use it to decide what you need to do. So if you're a person who wanted to get more conservative, do you use this as a time to do this? Do you take these points and get a little more conservative? If you're a person who wanted to actually take advantage of some of these dips and buy, you have to know how to digest this information. So yeah, first of all, we always talk about the individual's risk tolerance and where they are, and if they need to get a little bit more aggressive, or maybe they're right where they need to be. How do you digest this information? But anytime you get more and more of a recession type of information, it really looks that the market's going to take a lot longer to recover. So those that are relying on the market as a big part of their portfolio, it's going to take a little time for that part to recover.
All right, gentlemen, we're going to leave it there. Dan and Mark and Doug and Charles and Robert Gray, thank you guys so much for breaking down the numbers. All right, right after.